Accuracy-related penalties under IRC 6662 are a favorite EA exam trap because the names sound similar, but the triggers are totally different. Two big ones to know are substantial understatement and valuation misstatements. Your job is to spot the threshold, then match the right penalty rate. And remember, bad documentation, like missing appraisals, often turns a maybe issue into an automatic penalty exposure. For individuals, a substantial understatement exists when the understatement is more than the larger of two numbers, 10% of the correct tax or $5,000. Read that slowly. It's not 10% and $5,000. It's whichever is larger. On the exam, they'll give you the correct tax and the reported tax, and you compute the shortfall and compare it to both thresholds. Here's the classic example pattern. Jennifer's correct tax should be $9,000, but she reported $3,000 because she claimed a retirement contribution she didn't actually make by the deadline. The understatement is $6,000. Now compare. 10% of correct tax is $900, and $5,000 is the other threshold. The larger threshold is $5,000, and $6,000 is more than that, so it's substantial. Now, valuation misstatements. These are still accuracy-related penalties, but the trigger is about overstating value or adjusted basis. There are two levels. Substantial valuation misstatement generally means the reported value or basis is at least 150% of the correct amount. Gross valuation misstatement means it's 200% or more of the correct amount. Same concept, bigger exaggeration, bigger penalty. Match the level to the rate. Substantial valuation misstatement is generally a 20% penalty. Gross valuation misstatement is a 40% penalty. Also note a common extra condition in questions. The misstatement results in an underpayment of at least $5,000 for individuals. If you see a fact pattern with inflated charitable donations, conservation easements, or basis overstatements, your brain should immediately jump to 150% versus 200%, then 20% versus 40%. Documentation failures are what make these problems ugly. In valuation cases, the IRS will look for support like a qualified appraisal, especially for large, non-cash charitable contributions. If the taxpayer can't produce it, the IRS can disallow the deduction, and then the valuation penalty analysis kicks in. In the Gary example, he claimed a $900,000 conservation easement value, but the IRS determined it was $45,000 and he had no qualified appraisal. That's well beyond 200%, so it's gross, 40%. Quick exam checklist. First, identify the penalty category, substantial understatement versus valuation misstatement. Second, compute the trigger. For understatement, compare to the larger of 10% or $5,000. For valuation, compare reported value to correct value, 150% or 200%. Third, assign the rate, 20% for substantial, 40% for gross, and if the fact pattern mentions fraud, that's a different, higher penalty. Don't mix them. When a taxpayer is required to file an FBAR and doesn't file it, what penalties are they potentially subject to? The choices include civil and criminal penalties, only civil, only criminal, or just censure. Think about what the government can do when foreign account reporting is ignored. The correct answer is civil and criminal penalties. FBAR violations can trigger civil penalties for non-willful and willful failures, and in appropriate cases, criminal penalties too. The tempting wrong answer is civil only, because most tax penalties feel civil, but FBAR enforcement can absolutely go criminal when the facts support it. Ethan took a large charitable deduction that was later disallowed on audit, and he's assessed a penalty for substantial understatement of income tax. An understatement is considered substantial if it's more than the larger of 10% of the correct tax, or what dollar amount. The options include $25,000, $10,000, $1,000, and $5,000. Think about the individual threshold. The answer is $5,000. For individuals, substantial understatement means more than the larger of 10% of the correct tax or $5,000 under IRC 6662D. A tempting wrong answer is $10,000 because that number shows up in other penalty contexts, but not for this individual substantial understatement rule.